Good day, everybody. This is Ryan, and it is time to get started on Coach's Corner. And I hope you guys have had a great week. I hope you have a great weekend. If you see the camera there, I'm sporting my COVID beard and trying to decide what the right length is. I haven't done this for 30 years, and it was a totally different color than last time I did it, as I mentioned before. So I don't know if I'm even going to keep this darn thing, but it's kind of fun. I just haven't done it for so long. And, you know, do you keep it short? Do you make it grow a little longer? I don't know. I haven't done this sort of thing. So anyway, we will get started here. And Robert says you'll get used to it. You know, I'm still, you know, scratching and going, whoa, oh, that's right. I got one. I'm still getting used to it. Yeah, I'm not there yet. Thanks, Roman. All right. Hey, well, listen, guys, if you can see the screen, you should be looking at the introduction. And this is the disclaimer that we always put up. And we do that for a reason, because we just have to be careful. And I've never had a problem with this. I've never been accused of it, but we are not giving you specific advice. This is education. It's usually pretty clear that this is education. And any examples that we give are going to be examples of scenarios, but not specific trades, just so you understand that. And I think you do. It's up there every time. And if you're new, you know, take a look at it. But basically, I'm not going to be giving you any advice on trading specific. It's a educational forum, period. All right, some items coming up here. Guys, Rob's Trading You is regular. It comes up twice a month. You can see that there. We've got online classes that are available. The mastermind group happens. We've got an event coming up on the, I think, 10th and 11th of December as well. And let's see, we got that marked over there. No, there, but I know there's one other thing coming up. Anyway, you should be keeping track of these things and taking advantage of it every chance you get. Guys, I gave the introduction on this as of what I want to teach today is context. Context is everything. And that's exactly the point that I want to make here. Context is everything. So what do you mean by that, Ryan? This is just such a life lesson, right? It's like the idea of you putting the wrong emphasis on the wrong syllable. You know, all the pieces can be there, but it just doesn't work. And context is saying, hey, I've got certain pieces of information, or I've got certain tools, I've got a scenario. Does it fit what is being proposed? I'm going to build a bridge, and I brought along a slingshot. Okay, a slingshot is a valuable little thing in certain circumstances, but it's not very appropriate to building a bridge. And so I want to approach this. It's going to seem a little bit scattergun, but you're going to see there's a wide application. I will get into some very specific examples of it. But this is something that if you don't get this, guys, you're doomed. I'm just going to say it real bluntly, you're doomed. Because not having context as you approach trading is literally a guarantee of disaster. It really is. And so let's start with this premise: trading. Trading is trading is trading. I've taught that, I've heard it, and I've also taught the opposite, because it depends. You know, Tripp is very quick to always point out that one of the things that I taught my students for years and continue to teach is that the right answer to any question I ever ask you is it depends. It has to be in context, right? So trading is trading is trading. What does that mean? Well, guys, if you know how to trade, you can trade anything. It's a standalone skill set. You can trade stocks, bonds, futures, commodities, currencies, anything you want if you're a good trader, if you understand how to trade. That's a true statement, but it's so simplistic, because that "or is it" up there means, yeah, but okay, I understand trading, I'm a good trader. Does that mean that I can automatically trade commodities? And the answer is no, it doesn't. But could I? Yes, you could. because the skills to trade commodity are the same skills that it takes to trade stocks, bonds, futures, currency in a general sense, but there are specifics to trading commodities that are different than trading currency, that are different than trading futures or bonds or options. It becomes specific to whatever you're doing, although there are basic trading skills that are universal. So I just don't like generalisms very much. I don't like one size fits all. And somebody who says, well, I know how to trade this, I can trade that. Okay. That'll get you part way, but it certainly does not get you all the way in switching horses and saying, well, I rode that horse, so I can ride this one. Nah, horse riding is horse riding is horse riding. Yes, but no. Dressage, jumping, that's horse riding. So is riding on a pony at a birthday party, but it's different. Okay. There's basic skills to stay on the horse. I get that. But it's different with a dressage jumping than it would be riding a pony at a horse or a pony at a party. Okay. So there are common denominators, guys. Every trading element that requires, any trading endeavor requires strategy, rules, and tools. I think you can boil it down to that simple starting point. You're going to have a strategy. There's going to be a set of rules that go along with that, and you're going to have some tools that will help you. The object, the common denominator, is I want to get gain. Now, what if I want to just buy and hold and let the market carry me along like a lazy river? Okay, or a raging river from time to time, or rapids, or a waterfall from time to time. But I can get in and just sit down and float along and see what happens. Or I can actively trade on the other end of things with a high frequency trading system and execute, hundreds of trades in a second. It's all trading, but it's not. Okay. It starts to get squishy. So lions and tigers and bears, oh my. Here's some things that I think that are absolutely critical for you to decide. Why am I trading? Why? Hey, Butch, I just saw your name. Dude, it is so, I can picture your face, man. I haven't seen you for so long. Nice to see your face. And as I picture that in your name. Why am I trading? Are you trading for fun? Is it to supplement income? Is it for long-term growth? Is it to replace an income? You gotta establish that, because you can't put yourself in context if you don't have that. That's going to determine a lot of things just by picking one of those. Okay. How much time are you willing to commit? Is it too much time? I mean, if you say, I want to do it just for fun, but I'm going to do it for 10 hours a week, you may not have 10 hours a week to do that. I want it to be a full-time income, but I only want to do 10 minutes a week. You see, the things have got to match. What do you want to trade? Guys, there are some things that I just hate trading. I hate trying to trade. I've tried it, don't like them. There's other things I like. There's other things I really like that I shouldn't do. Okay, I found out I really like that, but that's cocaine for me, and that's not a good thing. That's not a good thing. So why am I trading? Establish that. How much time do I have to commit to it? Establish that. What do I want to trade? Now we're going to start to get into some default differentials here. It's going to differentiate out. If I can't match those first three up, I got a problem. I need to stop right there. If I want to trade for fun and I don't want to put any time into it, but I want to trade currency or some commodity that is active and I have to be on top of it, or I want to trade something that trades overnight, but I can't do that. You see, those things have got to match up. What time frame do I want to use? Next one. I'm not going to go too much into this. I want to give you examples of that. This is one that can really get people in trouble, but it can also be very, very helpful if you understand what that means. Now, time frame, like I say, I'll get into that a little bit more. Which tools do I use? Well, what kind of tools are there? Well, you've got technical indicators. You've got charts. You know, what charting service are you going to use? Are you going to look at patterns? You know, that's the next one. That's a tool. Am I going to look and use candlestick charts as opposed to just line charts. There is a whole list of tools that you can use. There's a whole bunch of patterns that you might use. Which ones you're going to use, how many of them, which ones are good, which ones are not good. What platform are you going to use? How are you going to manage risk? Every single one of these has multiple choice answers, and those multiple choice answers is ultimately going to frame your trading. And if you don't have a good handle on you're comfortable with that, it is truly a recipe for disaster. How are you going to survive the learning curve? You can trade live or you can trade virtual. They call it real or paper trading. Come up with some other fairly creative names, but basically you're trading with live money, live account, or you're trading with a paper account. Live is real. There's no mercy. You live and die by what happens. And I'll tell you what, when you look at paper trading, where it isn't quote unquote real, it has limitations. When you practice something, but you've never actually done the real thing, there's problems. I'll give you a real world example that comes from my personal experience with one of the special forces operators that our country depends on and should appreciate more than they do, because we don't know the most of what they do. They're doing things all the time, all around the world, and we don't know about it. But my friend shared with me that he was going through his training at the time that they shifted. They, meaning Congress, some members of Congress, had decided that it was absolutely untenable that people would get killed in training exercises in special forces because they use live fire, live ammunition training. And he said, I had just was finishing mine when this edict came down, starting at such and such a date, they were going to no longer use live fire ammo in training because they did not want to risk having anybody get hurt. You know what happened? He said in his career, he followed over the next few years, the incidence of fatalities in the field. In other words, they lost operatives in the field, operators in the field, went up substantially to the point where someone came back to those same congressional people who had put this thing in the first place and said, can you not see? Are you not able to comprehend that it may have been a good idea, but you are killing people? They can't be trained properly if they can't use live fire ammunition. They go into the field and you think it would work, but it doesn't. And guys, there's a good adage that says you cannot take the place of live fire training. You can't do paper trading and then switch immediately into full-on trading with live fire, live money, real consequences, and have it go smooth. At least I have never met anybody that happened. So I worked very hard to train people in a hybrid situation to where you make the trading without, the non-funded trading as real as possible. And then you switch slowly. Once you feel comfortable, you trade one contract, not 10, you trade one contract. And you get used to taking hits because the hits will come. And when they're real and it costs real money, it causes a different reaction than if it is unfunded. And so you gradually go into it by one contract, then maybe 5 contracts, and you work your way into it. If you don't, that abrupt change causes horrible things to happen. Okay? Horrible. So that simulation trading is magical if it is done in a way that simulates enough pain, enough reality to where it transitions. It actually works, but it's very difficult. Brandon says, I was in one of those last boot camps where the drill instructor could still physically hit you. Now we're going down a different road. It's the same road, Brandon. It's the same road. I know you know what you're talking about, but you're just going to get different results. If there's not consequences, you get different results. And with trading, it's terrible. Jonathan says sims are still used to teach flying combat planes, though. Boom. Jonathan, absolutely right. Can I tell you a little bit about that? I'm going to share something with you right now. I have flown a 747. I do not have a pilot's license, but I have flown a 747. The simulators are so good that if you can qualify in a simulator sufficiently to where they will give you a checkoff. You can literally walk onto an airplane and sit in the second seat and fly. That's how good the simulators are. I know that because I've been through that process a little bit. I've been in the simulators at Stapleton Airport in Denver, Colorado. I have flown for an hour and a half, 747. I've had several successful takeoffs and landings and one horrible crash. And that crash, I was told, could have cost tens and tens of thousands of dollars, and more than that, because you can break the simulators if you crash wrong, if you crash too hard. And if you do, it shuts down something that runs 24 hours a day, and they're flying in people from all around the world and running them 24 hours a day on training. And if you shut that down, it costs a couple of days where they have to fly a crew in to fix it, yada, yada. So if the simulators are sufficient, Jonathan, yes, it can be. And that's what I worked really hard, is to create simulators for trading that would give traders a strong enough experience that you could translate it directly into live fire training. And it works. But boy, oh boy, you got to be careful with it. And it's got to be done right. Okay. Risk management. Guys, cash flow versus growth versus speculation. The way you do risk management is different. If you say, oh, I read about this risk management strategy, it's really cool, I'm going to start doing it. Well, does it fit your trading? What do you mean? It's risk management. Yeah, but it's specialized, guys. Everything is in context. One risk management strategy may not apply to the way you trade, or it might. But if you don't qualify that, you're just throwing something up on the wall and hoping it sticks, and there's real money on the line. Risk management assumes that there's going to be costs. It's going to cost somebody sometime. When mistakes are made, there's going to be costs. So you have to manage that. The risk reward analysis is a critical piece of that. Is there enough reward for the established risk? Does that meet or match the trading strategy that I'm doing? Are these losses sustainable losses? Okay. Do I use percentages or hard costs? Okay, well, if I lose $300, I'm out of the trade. Or I have a 1% tolerance. If I lose 1%, I'm out of the trade. That is a risk management strategy. It may be a good one. It may be a horrible one. It may be a horrible one. Just because you have a risk management strategy doesn't mean that it matches or is right for you by any stretch. I bumped my mouse. There you go. It's critical. And guys, you got to decide if you're going to trailblaze or if you're going to follow a mentor. And I love the fact that you're here following different mentors. You're going to gain things that will ultimately shape and define who you are as a trader. Nobody's going to be an exact clone of anybody else. You're going to draw what you can from me, from Rob, from anybody that you listen to, that you can pull good things together, and that will ultimately decide who you are as a trader. However, the things that you put together in that context or in that form have to be in context. They all have to work together. They have to relate to each other. Okay? They have to relate to each other. Brandon says now they have stress chats. Do they have that? Don't tell me they have safe spaces in special forces training or boot camp. Please don't tell me they have safe spaces, because they probably do, and I just don't want to know. Every choice that you make, guys, is going to have subcategories. And I don't want it to sound like that it's an insurmountable task. It's not. It's just that everything you do needs to be put in context. All right, so let's shift into some specifics. I want to make a bold statement, and that is that price movement is infallible. Is there anything that's infallible in trading that is an absolute, that cannot ever be proven wrong? And the answer is yes, and that's history. Price movement is it. If it's happened, it's happened. You can't change it. You don't trade it. It's history. Why is that important? Because inside of that price movement, there may be something that you can use. And I say maybe because patterns that form in price movement are either there or they're not there. Well, that seems like it's pretty obvious. Well, yeah, I know, but I said it for a reason. Patterns are either there or they're not there. You may not see a pattern, either because you can't recognize it, which means it was there, you just didn't see it, or it doesn't exist. And that happens a lot, where I see people going, well, I think if you see this and that, oh, wait, there's no, you're making stuff up now. That's not a pattern. Well, and people will try and struggle with that. Trust me, there are some rules, there are some things that you can develop to recognize patterns. You may not see it, doesn't mean it's not there. But you also don't want to force it. If it's not there, don't force it. A repeating pattern can be there and then stop. It can disappear. You can have a pattern that went 3, 4, 5 times and then quits happening. Guess what? That's normal. That's what you should expect. 3 to 5 repetitions in a pattern that you recognize is normal. And then the pattern tends to break down. Why? Well, there's good reasons for that. I don't want to go too detailed on it right now, just from a time standpoint. But the fact is that if a pattern develops, there's a few people who are going to spot it. Not everybody, but the ones who spot it are going to start to manipulate it and anticipate it. As they anticipate it, they will break it. They start going in earlier and earlier, getting out later and later, and the pattern falls apart. The more people that participate in it tends to break it. Now, wait a minute, that would seem kind of oxymoronic. If more people participate in it, doesn't that precipitate the pattern? Yes, but the people who are very influential on it, who are jumping in and recognizing the pattern, are going to start jumping in early on the get in and early on the get out, and the pattern breaks down. It just happens. Okay. But the pattern is the best indicator of what is going to happen next. Absolutely. It is the best indicator of what's going to happen next. If it's erratic, it predicts erratic. If it's consistent, it predicts consistent. Okay. But not forever. It'll usually happen 2 to 3, 4 times, maybe 5, but usually in that range of about 3 times, and then it falls apart. Okay, so if you've seen something that's happened 2 times, there's a good chance it'll happen a 3rd time. If it happens a 3rd, there's a good chance it'll happen 4, but it's a depreciating chance. It might happen a 5th time, but not always. In fact, not usually. 3, 4 is the most consistent pattern that you'll see, or sequence of patterns happening. Another thing to make sure that you grasp is correlation. If you're trading a stock or a particular index or something, does it correlate to anything else? Does the stock you're trading correlate to the market? Does the commodity you're trading correlate to the overall market? If it does, then you can pay attention to both if they correlate. All right. It creates a general expectation for movement if you have multiple things confirming. Now, if you are trading a stock that doesn't correlate with the market, fine, then don't watch the market, just trade that stock. And you may find that it correlates with something else. But that's another tool that you can put in your tool belt, is to see if it correlates with anything. Guys, it matters if it matters. What I mean by that is, if it correlates, great. If it doesn't, don't worry about it. Well, I don't understand how to trade this stock. It just doesn't seem to do what the market does. Okay, was that your expectation? You only want to trade something that follows the market? Well, most stocks do. Yes, that's true that most of them do, but this one doesn't. Does that mean you don't trade it? No. If you can figure out how to trade it, trade it. The best teacher for trading anything, any entity, stocks, bonds, commodities, options, currencies, whatever, the best teacher is the history. So we go back up to the top. The price movement is infallible. It is historical. It's there. You can't change it. If you find patterns, it is the best predictor of what is going to happen next. And if you go back and study it for the last year or 2 and really study it, it will teach you how to trade it. The traders who's left footprints in the sand, who've done the trading over the last year, will teach you how to trade that stock or option or commodity. It will teach you how to do it if you can read the signs. So charts are going to be a powerful tool to use, no question. But when you use charts, it still continues to get muddy because now you got to deal with time frames, and that can be good or it can be bad. Okay, let me show you how it can be good. It should be obvious how it doesn't work, but I want to show you how to use time frames and put them in the right context. There's an ad that says, don't bring a knife to a gunfight. Hopefully it doesn't offend anybody. Nobody's that triggered by, just don't get me started. But you understand the principle. And you also don't chart leaps with a 5-minute chart. Same principle. A 5-minute chart is wonderful, but not for trading leaps. Okay? There's different time frames, and you should use those. But don't get trapped by getting information overload or mismatching things. Trading is all about pulling the trigger, and the trigger is pulled usually, if you're using a chart, based on something crossing a line or completing a sequence or whatever qualification it is on that chart that will come up as a as an indicator in a type of a candlestick or crossing a trend line or whatever it may be, support or resistance. It's about pulling the trigger. If you change the time frame, pardon me, if you change the time frame, you can change the signal. You can be looking at a time frame, especially, and guys, this comes into play more with the folks that are trying to trade commodities and futures and things where they're watching it during the day. During the day, people change time frames a lot. They'll look at a 2-minute chart, a 5-minute chart, a 15-minute chart, a 13-minute chart, and they're using it to try to make decisions. And you can get into trouble in that by getting too much information and getting too focused on a context or a time frame. I've seen it. I've done it myself. I'll tell you, I've done it, and I've seen a lot of other people do it. Even intraday, you'll get confused. You'll be watching a certain chart and you're watching a signal, and you'll leave it on a 5-minute chart, but you already decided that you were going to make your decision on a 2-minute chart. Do people do that? Yeah, they do. They do. They're going to say, when the 2-minute candle crosses this point, I'm getting in. But then they look back at a 5-minute or a 10-minute to get the big picture, and they'll forget and leave it on the 5-minute, and they'll miss or they'll make a mistake on their entry point or their exit point. You have to be careful. Charts can scale from 1 minute to a year, typically, and there's reasons to use these different time frames for sure, but it's got to be something that you use with skill. It's got to make sense why you're changing time frames. And like I say, it's not just a default that you will understand how to do that right or why to do it. And if you're not doing it, you may be missing out on some critical information that would help you a lot. Okay. I got to give Brandon some props. I have a nephew that did buds and also dropped out. Brandon said, I did buds and dropped out. Guys, if you can even qualify to get to buds, there are no losers. The fact is, when they're training special forces like SEALs, for example, they already know that they're only going to take the top maybe 2 out of 10 people. And essentially, Brandon will tell me if I'm wrong, essentially, they're going to push people to the point where everybody drops out until there's 2 or 3 out of 10 that will essentially say, you can kill me, but I'm not going to quit. And that's what they're looking for. Everybody else is incredibly good, but they're looking for some special breed of crazies that will just absolutely not let go until they die. But the bottom line is the fact that you get there puts you at several cuts above, from the, you're real close to the top just to get there. And anybody who falls out is much better for having done it, and they become better in their service. It's just so stratospheric, and they're only going to take 2 out of 3 out of 10. That doesn't matter how good you are. They're going to push until there's only 2 left, and that's the ones they take. That's simplistic, but I think it's true. I know it's true. All right, back to this. If you're trading a pattern, the time frame and the strategy have to match up. Now, I'm going to give you some context on this, so this will be kind of fun here. Very good, Barry. Nice. That's good props. That's great. Felicia says, unless you're day trading, does it make sense to look at charts under 1 day? Yes, it does. It does. And I'm going to show you, Felicia. I'll give you some examples here. All right. So I ran across, this was kind of funny. I ran across this term, a sushi roll. And when I looked it up, I thought, oh, that's kind of funny. That's kind of cool. It's called, I was reading it. Guys, you know that I'm a candlestick expert. And I saw an article that said the 5 best candlestick patterns. And I'm going, okay, I'll bite. I want to look at that because I already did 17 million days of analysis, or 14 million days of analysis. in candlesticks, looking at frequency and accuracy. I know which candle patterns are the most accurate and which ones are the most practical to use and which ones aren't very good. In fact, most of them aren't very accurate, period. And it turns out that in most cases, the most accurate candlestick patterns are ones that you don't want to learn. Doesn't that sound weird? The most accurate candlestick pattern, I tell you right now, you don't want to learn the top two. Anybody have a guess why? This would be an issue. I don't expect anybody to get this answer unless you've read my book. But does anybody have an idea why you would not want to even know what the two best, most accurate candle patterns there are? Boom, Tripp knows. I would be disappointed if you missed that one, pal. Tripp says they don't ever occur. That's right. Their frequency is so seldom. It's so seldom. What good? Are you going to spend the next year studying 50 stocks, hoping that you'll find this one pattern happen one time or two times? Come on. What you want is the ones that happen frequently that were also high on the accuracy level, because they're the ones that are going to happen regularly and they're ones that you can use. And if they're quite accurate, let's say they're 75, 80% accurate, 80 is pretty good. But guys, nothing is higher than about high 80s. But those that are in the high 80s, almost 90% accurate, you're never going to see them. Anyway, I saw this engulfing and sushi roll, and I thought, well, okay, I know what engulfing is. Bearish and bullish engulfing patterns look like this. If you have a bullish engulfing pattern, it means that you've got a bearish candle first, and then you completely wrap it with the body, not the tails, with the body. The tails are added to that, but the body has to completely wrap it. And this first body can't be a little body. It's got to be a normal body. By definition, the first red candle that you're seeing on the left has to be normal. Well, how do you define normal? Is it 1 point, 2 points on the day, 50 cents, $4? It depends, right? That's the right answer. It depends. Show me the stock. What's normal for that stock? If the average daily movement on that stock is $3 and you're looking at a $1 candle and then the next one engulfs it, don't tell me that's an engulfing pattern. Technically, it's engulfing it. Yeah. But it's not the bullish engulfing pattern. You've got to have normal activity to start with. So it's got to be in the normal range, and then you go abnormal and engulf it. That's the bearish or bullish engulfing. Reverse it, and you've got the bearish engulfing. And then you've got the sushi roll. And I'm going, what the crap's a sushi roll? So it turns out it has nothing to do with anything except some guys were sitting around at lunch, and they were having sushi, and they came up with this idea, okay? And so they called it the sushi roll. That's where it came from. And all it is this. Oh my, it kind of looks like the bullish engulfing, bearish engulfing. It is. But all they do is they look at 5 days. They look at Monday through Friday, and they draw one candle for 5 days. It's a weekly chart. It's a weekly candle, for crying out loud. And then if the following week engulfs it between the opening price of the week and the closing price of the week, then it's called a bullish engulfing sushi roll. And again, I don't know the significance of the sushi roll other than apparently they were at a sushi bar when they were eating. They came up with this idea. Guys, is this brilliant? No, it's just a change in the time frame. Traders have been doing this forever. This is not unique, except they're saying, well, this really can be, all it is a different way of looking at the same thing. You can do it on a monthly. And then what would you call it? If it's not a sushi roll, you call it something else. But you can look at a weekly chart and you'll come up with the same exact picture as a daily chart. And does it mean the same thing? Yeah, it can. It can mean the same thing. But your reaction to your trading to it might be different. How so? Well, you wouldn't be looking at weekly charts unless you were looking to go into something for a longer period of time. If you're looking at a weekly chart, you're looking at taking possession of something for maybe a month or two or more. Why? Well, I'm saying that generically, but I even want to bite my own tongue and say, but Ryan, you know better than that. That's true. That's true. Why would I look at weekly charts? Probably with a longer term, no doubt. But let me show you on a weekly chart. This is a weekly chart right here. So this is Google on a weekly chart. And you can probably find a bullish or bearish engulfing pattern in there. But the point is that if you were taking a position on Google and you were trying to take a bullish position, I would invite you to do something else and add to or augment that signal. If you were looking for a longer term position on Google, could you use that bullish or bearish engulfing pattern? Yeah, if it shows up, but you can also use a pattern that's following a line. And you can also help your expectations by doing this. So watch, see, give me a clue here. Guys, can you see my mouse? I don't know if it shows up. A cabbage roll. Helen, that's beautiful. Pig in a blanket, a burrito. Some great answers, guys. I love it. Can you see my mouse here moving or not? It's important that I know if you can see it. I'm down in the bottom left corner. No? Okay, so I will do this then. I was hoping you could see the mouse, but that's okay. All right, you can see this. How long of a run did this last for Google on this upside? 1, 2, 3, 4, 5, 6 weeks. And then it stopped running. How about this one? 1, 2, 3 weeks and it stopped. How about this one? 1, 2, 3, 4, 5 weeks and it stopped. How about this one? 1, 2, 3, 4, 5, 6, 7, 8 weeks, and then it plateaued. And there hasn't been another one. Okay. So what do we got? We got 7, we had 5, we had 3, and we had 3, and then we had 4, 1, 2, 3, 4. So is there a pattern? Well, if there is, it's pretty sporadic. Okay. We have 5 right there. We have 3 right there. We have 4 right there, and we've got 7. So is it growing? No, it's kind of exaggerating. So what do we have? We have a range of 3 to 7 weeks. Now, guys, this is where we start. I'm showing you how to put pieces together and do just some analysis. I'm saying, Google, teach me how to trade. Teach me how to trade you. If you break and take an upside move out of a pattern, actually, this is only 1, 2, well, we'd call this a 3. You can get away with a 3. So we have a 3, a 3, a 4, a 5, and a 7. Over what period of time? This is 1 year. Okay. I've got a 3, a 3, a 4, a 5, and a 7. If you were to grab an entry point on Google on an upside breakout, you would expect to be able to be in that for 3 to 7 weeks, but probably 3 to 4 weeks is most reasonable to expect. You might get 5 weeks and you might get 7. It's happened, but it happened 3 weeks twice, 4 weeks once, 5 and 7 once, respectively. Now, what's interesting, obviously the 7 week had the biggest gain right there. 5, pretty big gain. This 3 was just as big as the 5. This 4 was just as big as the 5. And then we've got a shorter 3 right in here. So now you could look at this and say, well, how many points is that? So this is how many weeks. And then we could look at how many points did each one of them get. And you know what we're going to come up with? We're going to start to come up with a method for trading Google that's based on realistic expectations. What's realistic expectations? Now, are we going to enter this on a weekly chart? Well, you could, but let's go back. Let's look at this again and say on the same chart on a daily, this is a daily chart. Okay. And I want to go, I just want to do this. So there's your first, and now you can't see too far to the left, but this was a support level. There was a reason for this to take off here. So if we look at this and say, I see a little break in a downtrend here, that's an entry point right there. Now, we stay in it, keep climbing, it plateaus. And when it plateaus, at some point in here, you get out. Okay. Now, if we got in here and we got out here, how long were we in? Well, it looks to me like it's about 3 to 4 weeks. Yeah, 4 weeks. Yeah, easily 4 weeks. Okay, well, does that correlate with what we were looking at here? Well, yeah, it does. So if you got in on this after this first green candle that broke up, and you got in right here and you stayed in 1, 2, 3, 4, 5, and then it plateaus out and you get out of here somewhere about right in here. Oh, that was a decent run. Could you have done it on a weekly chart? Well, maybe. You see, what I'm doing is now I'm filling out one more piece of information. I'm trying to figure out how to trade Google. Can I trade it off? Do I have to trade it off of a 1 day for entry, or could I do it off of a weekly entry point? Well, sometimes it can be safer to wait on the weekly, but you also give up. If you have a big week, you're going to give up a lot, where on a daily basis, you would have jumped in. For example, we'll back here again. Once we come down and we bounce, we form this base right in here, and we form this little triangle. We've got a wedge there. Once it breaks out of that, right about in here there's the gap, and there's the compression into the wedge right there. There's your entry point. Trades up, pulls back a little bit, comes up, it gaps up again, climbs, and then gaps back down and goes sideways. So somewhere between here and here is the next trade. And what do we got? It looks like about 4 to 5 weeks if you stayed in a long time. 3 to 4 weeks if you bailed once it quit moving. Okay. So now what we're trying to determine is, would it be better to trade in on a daily or a weekly? And right now, I don't know yet. Day or week? What do you guys think? Have you already got it figured out? Do you know that it would be better to take weekly entry points or daily entry points to get in on trades for Google? Do you see it yet or not? Butch says daily. Okay. Would it work on weekly? It looks to me like it would. And you know, the reason that I asked the question the way I did like that was to try to elicit you to give me an answer. But the answer I was hoping to get is, it depends, or keep going. See, I can go through each one of these scenarios. There's a big jump up. We pull back down to this, where it moved to the top of the trading range and then launches. There's a nice bullish entry point right there. Come out of that wedge. Okay. Does it work on a weekly at the same place it does on the daily? Well, let's see. We have that breakout on the weekly breakout that breaks out above. So that's right there. That's right there. Oh, that would have been late. That would have been better, as Butch said, to get in on the daily. The daily would have got you in 3 or 4 days sooner, a few points, and then you ride this up until it runs out of gas. So in essence, what I'm doing is I'm saying, hey, Google, teach me how to play. I want to know how to play Google. Teach me how to do that. And guess what? It will do it. But you have to put it in context. You say, am I trading Google for the year? If I am, then I get in here and I stay in and I'm still in. Am I trading cycles? A surge. Okay. So if I'm buy and hold on Google, there's buy and hold entry right there, and you're still in it. If I'm playing a trend, I'm still in it. If I'm playing a surge, then I've been in and out several times. If I'm playing it on a day trade, then I'm going to play this whole thing, only I'm going to do different time frames in minutes. And I'm going to take just little 5-minute, 10-minute runs. Maybe it depends. I haven't looked at it on a minute chart yet. But in other words, if you decide what you're going to do, let's say we're going to play surges, then you do this analysis that I'm doing on this. We're in a bullish trend, so I'm going to catch the bullish surges. Okay, I'm going to catch the bullish surges. That's what I'm looking for. That's going to give me a time frame. It's going to set up a whole different set of rules. It's going to give me an option to use daily and weekly for sure. I would definitely do this. I would definitely use weeklies, and I would look back and forth. But in studying it, I'm going to use the dailies and the weeklies to decide if this is the right way to trade Google. You see, right now, if you just pull the chart up, you got a question mark. You're saying, how do I trade Google? It's a good answer. How do I trade Google? Going forward. Going forward, the past will tell you exactly how to trade Google. Now, I brought this up for a reason. I saw this chart and I thought, oh, this will be good. I want to show you guys something. Right here, and let's see, I'm going to change, I got to change color here. Oh, come on. Let me change color. Ink color. There we go. I'm going to use the green because I'm illustrating with that. I want to show you. I showed you this chart here, guys, 2 months ago. I showed you the chart here 2 months ago. That's where it stopped off. That's where it was right there. And I had drawn these blue lines that showed when Google changed direction, we had a trend based on 1, 2, 3, 4 hits. We started doing the parallel lines off of the resistance levels right there. So we had 2 resistance levels and we extended those into the future. The pattern, now watch how this goes. There's one pattern, there's one surge. There's the other one. There's 2. It starts into a third, but it never returns because we have this big gap right here. It never returns back to the blue baseline, which is the baseline, the growth line that it was starting on, the trend line. With that gap, it became more bullish. So we came back and you can see we pounded out on this line, but we didn't break through and come back to here. We came a little bit and we said, no, we're going for it. There's the wedge, the gap, the base, the descending tops, and the explosion out. And now the orange trend takes over. And we have 1, 2, 3, 4, 5 hits on that orange line. We have a parallel line just above it that has 1, 2, 3, 4, 5, 6 hits on that. Not a coincidence. We established the new top line off of the last high, and we hit it once, twice, 3 times. The pattern, guys, follow it. 1, 2, 3, and then it breaks down. And there's smaller patterns inside of it. Now, when this pattern broke down, which is right here, when I was showing this to you last time, it had broken here. I had this dotted line drawn in saying, this is the target. And when it broke down, it came right back down. And that was the first target. It's dotted in there because this is the real target. If it's going to take this change of a more steep angle and break out of it, it's going to drop. And it's going to try to find anchorage back on the original trend lines. It bounced off of this one. It did not drop down. It's traded into a wedge again. And now we're surging up. And there's our retracement back down to the line. So I'm extending the lines now again. And this is establishing. This is the same blue. You know what? I should have made this one blue. This is important right here. I'm going to change color. There you go. I drew this because this is a new line, but this should be blue. The green ones were the ones that I'm making observations on now to the original chart I showed you. But the blue is parallel with the blue trend line. And we've come up, hit 1, 2, 3, and back down to here. If it falls through that green line, my prediction is it will go to here. In fact, I'll tell you that's exactly where it goes. How do you know that, Ryan? I know it exactly. You can't say that. You're right, I can't. I'm playing with you here. But I can tell you it will go there if it follows the pattern. If it follows the existing pattern that Google's been doing for a year, it will go to this blue line. If it stays on this green line, it's also following the pattern. It's the trend line. It's just running. It's just decided to set the base at a higher point, but it's not. It doesn't have to go back down here to get everybody on board. If this lines up and it works, that becomes the new baseline for the next series of 1, 2, or 3 rotations. Google will teach you how to trade it. But you've got to go back and say, okay, what are the patterns? Now, does Google correlate with the market? I don't know. If I can get a good pattern like this, I really don't care. I would check it just for the heck of it, but I'm not going to be dependent on the market. Does it? Well, probably, but we'll see. But that would be another thing to do, is check for correlation to see if it correlates with the market. There might be another stock it correlates to. Again, it's context, guys. It's context. Does it do the 3 to 5 rotations on a pattern, on a bullish run, or on a surge? Yes, it does. Does it have any patterns that tend to repeat themselves? If you haven't seen it already, guys, it does. It does. It does. Let me back up and get a clean version of it. I had a couple of them up here for a reason. There you go. Look at this. This wedge type pattern for Google is normal. It happens a lot. It's the breakout pattern. You get a baseline, you get descending tops, then you get a breakout and a surge. And that surge lasts 3 to 4 weeks. Occasionally it'll go 5 to 7, but typically you're looking for 3 to 4 week surge, a push. Trades into another wedge. And by the way, how long are the wedges? Well, this one was almost 3 months. This one was a full 2 months. This one here lasted 2 months. This one lasted a little over a month. This one here has lasted a month and a half. So how long if there's a pattern? They're triangle breakouts. They last how long? 1 to 2 months, typically. That's this way. The burst, how long does it last? Well, we figured that out. 3 weeks, 3 to 4 weeks. You see, if it's there, 1, 2, 3, 4, 5 times in a year, pretty significant. So does that mean you could use this to trade Google going forward? Absolutely. This is how I would trade Google going forward until it breaks the pattern. I would project these out here. This is the new top line that's coming in there, that's parallel. I would project this out and trade it until it breaks. It'll either break down or it will get excited and change direction and go on a steeper angle for a while and then fall back to the original. And guys, this will last as long as it lasts. And when it stops, don't try to force it. Don't try to keep making it do, well, I'm trading. Guys, I used to work with / for a guy who was brilliant on a lot of levels, but so egotistical on other levels that it was criminal. But when the markets changed and the strategy that he had made a lot of money on in a different market, in a bullish market, in the bearish market, nothing was working. So he said to his trading team one time, I want you to go back and start selling naked puts. But that doesn't, no. We made a lot of money on that strategy. Nothing else is working. Try that. Okay. On the one hand, you could say, well, that makes sense. We made a lot of money following that particular strategy in the past. That's true. But we're not in the same market. We're in a bearish market. It's going down. You don't sell naked puts into a bear market. But no. He insisted. And guess what? They lost a couple $100,000 in 1 month. It didn't fit. It brought a knife to a gunfight and got beaten badly. But it was desperation because, well, it worked before. Let's try it again. All right. Hey, thanks, Butch. I appreciate it, buddy. That's kind thoughts, kind words. Alan says, in hindsight, I can figure out where to get in and get out. However, what is in the intraday chart that tells you this is the day? Okay. So now let's drill down and answer Helen's question, because it's a great question. All right, Helen. I'm just going to draw right here in this corner for you. Okay. On the big picture, you've identified this right here. You've identified this wedge, and you're on that day looking for it. Okay. Now, it may be so well defined that you've been up and you've hit it once, twice, 3 times in the last 5 days. And as a result, you've said, if it crosses that point, I'm in. Okay. If it crosses that point, that's doing it on a minute chart, 5-minute chart, 10-minute chart. It doesn't matter. It's going to be triggered as soon as it crosses that line. In other words, instead of waiting on a day chart where you wait till it stops at the end of the day and say, okay, tomorrow I'm getting in, you would get in when it crosses that line. So you can set that up as a contingency order that will trigger automatically, but that's going to say, I don't care when it happens, to the minute, to the second, when it crosses that line, I'm in because this is the strategy or the criteria I've set up for entering into it. What if it takes a big breakout that day and it does that? Are you going to get in the next day? Chances are you'll be afraid. And if it turns around and pulls back, you'll go, oh, I'm sure glad I didn't get in. Tomorrow I'll get in. And tomorrow it gaps up and it runs again and leaves you. And now you're just sitting here wringing your hands and kicking things and saying bad words because you missed your chance. So on a daily, you may miss it. If you've got a clearly defined entrance, you can put a contingency order to enter on the trigger. Does that make sense, Helen? So you're not dependent on waiting on a day chart to make that decision. Ralph says, is the big money following these lines or making these lines? Hello, Ralph, what do you think? Seriously, I'm asking, what do you think? You're welcome, Helen. Jonathan says, do you only enter breakouts in either direction, or would you get into positions when it's trending? No, you can get into positions if it's trending, but you have to have a reason, Jonathan. You'd have to show me, before I would sign off on it, you'd have to show me that it's safe to get in on a trend because they last long enough to where it doesn't matter where I get in, I can get in as long as the trend hasn't been going longer than 3 weeks, I can get in and expect to get 1 week of movement out of it. Okay, that's a reason. Yeah, you're not going to get all three, but if you can justify it. But does that make sense, Jonathan? You got to be able to justify it. You got to be able to show me, like I've shown you, that here's all the reasons why it's good to do that. And because it's going up is not a good reason. It's trending. That's not a good reason. If this thing trends 3 to 4 weeks and we're in the 4th week and you're going, well, it's still trending, I want to get in. I'm going, no, absolutely not. Okay. So Ralph, back to your question. I asked you a question. You didn't answer me. What do you think? Do you think big money or the influential traders in this stock are following the lines or making the lines? Right? Ralph isn't going to answer me. He thinks I'm trapping him. I'm not trapping you. Okay, here's the answer. The key influential traders, guys, are making these lines, okay? But they can't do it by themselves. And when I say line, Ralph, here's what I'm talking about, okay? When we say a line, we're talking about bouncing off of this line or coming to a concentration of a few days right at that line. The big money are the influential traders on it, and I don't necessarily call them big money, but the influential traders on that can influence this right here. They can influence the bounce, they can influence the break right here, but they can't take it from point A to point B by themselves. They don't have the horsepower to do it. Nobody has the horsepower to do that. The market does that. So if they can see the pattern and throw in a little extra juice at a certain point and push it across the line, which they can do. And if that gets everybody going, ooh, I get it. And they all start jumping in, and then they tell 2 friends and they tell 2 friends and they tell 2 friends, and you get a big momentum push. As soon as that momentum push starts to wane, those same folks that nailed that here will turn around and sell at that point there just to see if it's the right time. If they sell and everybody goes running for the bushes, they go, nailed it. But if they sell and everybody goes, no, I'm still buying, then they'll reverse and jump in and push until they think it's running out of gas, and then they'll sell. But at some point, they're going to sell. It's going to trigger a panic, and down it goes. And if it's done it at a certain price 3 times over the last year, boom, guess what? This is not an accident. That is not accidental. All right. Ralph says, my question was serious. I didn't think it wasn't. I believed it because I take it very serious. Does big money say, oh, here's the bottom? And I think I just explained it to you. Big money would come down to this point. As the stock's moving down here, they know that it's failed right here to go any farther. That means there's a willingness in the part of the overall market to jump in and support that stock at that price, and they've demonstrated it before. So what they will do, Ralph, is when it gets here, they will jump in and buy and bounce it. They have enough to bounce it a day or two. If that triggers everybody who was anticipating this to jump in, then they nailed it. They smile and sit back and let the herd raise the boat for raise the flag for them, or the water rises the boat, whatever, right? But they're going to bounce that there because they know that there's history, and there's a certain amount of, well, what are they going to do this time, Ralph? You know, people who see this they see it, but they're not quite sure what to do. Is it going to do it? I don't know. Is it going to do it? The key traders will jump in and bounce it to test. And if it works, they're the first ones in. If it doesn't, they'll short it like crazy, push it across the line, try to scare people, and then go short more, and then sit back and watch everybody run for the hills. Does that make sense? So it's a serious question, and that's the right answer for it. All right, guys, I think we're out of time, and this hour goes by so fast. But I just wanted to show you one other thing, if I could, just show you. This is a daily chart. Okay, each one of those is a day. This is a weekly chart of the same thing. Okay, so can you see entry points? Sure. Can you see different entry points when you change perspective? And the answer is yes, you do. But it usually changes the amount of time that you're getting in. However, as I said to Helen earlier, there's a lot of strategies for trading like futures and indexes where you're working on a daily chart like this, and you will look at a 10-minute, a 30-minute, and a 5-minute, and then you'll pull the trigger on a 2-minute. The 5-minute and the 10-minute set up the scenario, set up the support area, set up the consolidation, and then you establish from that where you would get in, and then you switch to a 2-minute chart so that you get in as soon as it hits and not at the end of a 5-minute or a 10-minute chart. Okay, so the context is critically important, but there's got to be a reason for doing it. All right, Felicia, nice. She says incredible amount of information. It is, and I didn't go into great depth on many things, but I just want to show you that there is a reason for you to kind of pay attention and try to get things to line up in context. Does your strategy match with your time that you've got available? Does your personality, does your mood match for the type of trade that you're doing? Are you using indicators that are appropriate for that stock? Do they have a history of working? Can you go back a year and show how this indicator accurately predicts repeatedly? Are the candlestick patterns you're using, do they mean anything on that stock? Do they mean anything at all? They may not mean anything at all. Like some candle patterns don't mean it. I don't care, it's 90%. If there's 3 of them in 1 year, I don't care. It's not helpful to me, right? Everything has to be in context. Thanks, Helen. You have a great weekend too. Everybody, God bless. Have a great weekend. And we will see you again soon. Take care. Bye now.